Welcome to your ultimate pit stop, Piston Pundit. The door didn't slam, it was quietly, ruthlessly sealed shut. In early 2025, China slapped a 10 to 15% tariff on U.S. crude, LNG, and coal. Almost instantly, Chinese refiners turned their backs on American energy, favoring barrels from Russia, Saudi Arabia, the UAE, even Iran. By mid-year, U.S. shipments to China had all but vanished. Replaced by UN-based contracts and new alliances, this wasn't just a trade dispute, it was a seismic reset. With China ditching the dollar and rewiring its oil map, American producers are left outside, watching the world's biggest oil market run without them. Here's how that shutout unfolded, and why the U.S. may not find a way back in. Tariffs spark the collapse of U.S. oil trade. In February 2025, China hit U.S. crude with a 10% tariff and 15% on LNG and coal, prompting Chinese refiners to halt bookings almost overnight. Even heavily discounted American barrels were left untouched. Shipping data told the story, from roughly 160,000 barrels per day early in the year to near zero by mid-2025. No big announcement, just silence. Contracts lapsed, bookings dried up, and tankers stopped moving. A temporary 90-day truce reducing tariffs to 10% failed to spark a rebound. The economics had already shifted, and so had the infrastructure. This wasn't just a volume loss, it was a strategic retreat. Export terminals, pipelines, and shipping lanes built for China-bound oil went underused. U.S. producers found themselves locked out of a market they'd come to depend on. Analysts called it what it was, not a pause, but a turning point. The U.S.-China energy link didn't just weaken, it was dismantled. Gulf Coast exporters, once expanding confidently into Asia, were suddenly left hunting for buyers in a world that had moved on. And speaking of where those barrels ended up, China's crude compass points elsewhere. As U.S. barrels vanished, Chinese refiners wasted no time pivoting to alternative sources. Discounted Russian crude surged in, sidestepping Western sanctions. Saudi and UAE supplies followed, offering long-term stability. Even Iranian oil, often routed through shadow fleets, gained traction, especially with China's smaller teapot refiners. By mid-2025, analysts estimated China was importing over 1.7 million barrels per day of Iranian crude, much of it quietly bypassing formal scrutiny. These weren't temporary workarounds. They were locked into multi-year UN-based contracts that rewired payment systems and blend logistics around non-US origins. Refinery activity surged too. In June 2025, throughput climbed 8.5% year-over-year to 15.15 million barrels per day, the highest since 2023. With 4 consecutive months of surpluses above 1 million barrels per day, Chinese refiners had the cushion to store or export at will. What came next was almost surgical. Pipeline routes, payment rails, and blend specs were all re-engineered. The U.S. wasn't replaced in crisis, it was smoothly cut out. For American producers, that exclusion now looks structurally permanent. Before we venture further, hit that like and subscribe button. Supporting Piston Pundit helps us reach more auto and energy enthusiasts like you. Now let's zoom in on the currency shift that helped make all this possible. Dedollarization and China's financial sovereignty. China's new energy play isn't just about shifting barrels, it's about shifting currency. In 2025, long-term oil contracts with Russia, Saudi Arabia, Iran, and the UAE are increasingly denominated in yuan, sidelining the US dollar and expanding China's financial influence in global energy markets. This isn't just symbolic, it's structural. UN-based deals reduce exposure to dollar-linked risks and sanctions, while also reshaping how oil volumes are booked, payments cleared, and insurance handled. U.S. leverage in global pricing, once backed by dollar dominance, is losing its grip. Analysts report a sharp rise in non-dollar contracts this year, making it harder for U.S. suppliers to compete, even on price. With China's financial ecosystem tailored for UN transactions, American oil isn't just less attractive, it's incompatible. U.S. crude isn't just excluded from a buyer's list, it's excluded from the system itself. And that leads to a bigger question. Even if American oil becomes cheaper, how does it re-enter a supply chain now custom-built to operate without it? And the financial exclusion has real-world implications, especially for infrastructure. Infrastructure on standby and a scramble to recalibrate. For years, U.S. oil infrastructure was built with one goal in mind: feeding China's booming demand. From Gulf Coast terminals like Ingleside and Loop to pipelines engineered for Asian routes, America's fossil fuel ambitions were welded to Chinese contracts. But by mid-2025, with Chinese refiners slamming the brakes, all that meticulously laid groundwork now idles in neutral. Redirecting supply to Europe, India, or Latin America may seem like a fix, but it's not that simple. These alternative markets are fragmented, fiercely competitive, and much smaller in volume. Margins are slimmer, contracts are shorter, and geopolitical friction makes long-term planning a gamble. Producers are now staring down underutilized pipelines, half-filled storage tanks, and shrinking ROI. The infrastructure was built for an Asia-centric export model, and with China out of the equation, it's like owning a race car with no track to run on. Industry analysts are ringing the alarm. Unless something gives, whether through aggressive policy incentives, unexpected global shocks, or breakthroughs in trade talks, the entire U.S. export model may need an overhaul. And speaking of trade talks, let's check in on diplomacy's role in this energy standoff. Trade deadlocks and China's energy reboot. When U.S.-China trade talks resumed in Stockholm by mid-2025, energy wasn't even on the agenda. Washington warned of 100% tariffs on nations buying sanctioned Russian or Iranian oil, but Beijing stood firm, asserting energy sovereignty and rejecting outside pressure. A brief tariff rollback to 10% offered little hope for U.S. exporters. China pressed forward with long-term contracts, UN-based payments, and stockpiling strategies, reinforcing a shift away from American supply chains. By mid-year, China's surplus crude hit 1.42 million barrels per day, giving refiners cushion to ride out market volatility. These reserves are filled with non-U.S. oil, embedding reliance on rival producers. Meanwhile, China's EV revolution is in full swing. Over 14 million charging stations, and nearly half of new car sales now electric. That forward-looking policy erodes long-term oil demand, weakening future prospects for U.S. fossil fuel exports. Amid global instability, tariff threats, Russia sanctions, and Middle East flashpoints, China's systems hold steady. The result isn't just exclusion by policy. It's a full-scale energy realignment designed to leave U.S. oil behind. Verdict: the final turn. Can U.S. oil catch up, or is the race already lost? The U.S. didn't lose China's oil market in one fell swoop. It happened incrementally, through tariffs, contract lapses, logistics rewiring, and above all, China's strategic decisions. What replaced American crude wasn't just cheaper oil. It was a fully integrated system of supply, payment, and redundancy, backed by yuan and shielded from dollar dominance. Even after the tariff détente, China hasn't flinched. With its buying channels optimized for Russian, Emirati, Iranian, and Saudi oil, and its EV policies speeding ahead, the future doesn't include a prominent place for U.S. producers. Unless Washington brings bold energy diplomacy or Beijing rewrites its roadmap, American oil remains parked at the curb. Now we turn to you. Do you think the U.S. can rebuild a competitive export strategy, or has the engine already stalled? Could China's EV push permanently reduce global demand for U.S. oil? Should American producers pivot harder toward alternative buyers, or wait for a geopolitical reboot? Drop your thoughts, counterpoints, or hot takes in the comments. This Piston Pundit pit stop isn't just for updates, it's for smart discussion. And if you haven't already, subscribe to Piston Pundit for more high-octane updates and vehicle industry insights. Thanks for watching. Check out the next video on your screen, and we'll catch you in the next lap.